This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The Fed and artificial intelligence continue to hog the headlines, while bullish narratives like broadening participation in the upside, improving earnings estimates, and a still cautious retail investor should be getting more play. Up next, I'll try and shed some light and also discuss how future bond returns are potentially becoming much more competitive with what we should expect from stocks. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. I'm Simon Hamilton, Managing Director here at the Wise Investor Group of Raymond James. A lot going on, most of it favorable. Yeah, there have been some pockets of weakness in the market here and there, but overall, it's hard to argue that the trend has been quite positive since really last October. You know, here we are, kind of 5 months of pretty strong momentum across the board. And of course, the investment community has responded to that. I was reading a piece from Charlie Bolello. He was saying that when the S&P last October was back at 4,100, active money managers had less than 25% exposure to equities. Fast forward to today, with the S&P over 1,000 points higher, active managers, in his words, all in, moving their equity exposure above 105%. You're above 100 because some of that is leveraged long, but still 25 to 105 in less than 5 months. That's the highest reading, according to Bolello, since November of 2021. That was kind of the peak of the post-COVID crash surge, right? If you remember that. And then if you go back a little bit further, go back to the October 2022 bear market lows. Bulls at that time were in pretty short supply. If you look at the Investors Intelligence Survey, which I've tracked for a long time, it's a really good reading of investor sentiment. Only 25% bullish at that time. About a week ago, that is up to 60% for the first time since July of 22. So clearly the professional investor community has gotten a lot more bullish in a short period of time, and so it would not surprise me at all if some steam came out of the balloon at some point. Remember, and I've said this pretty much every week I've done this podcast for years now, that we average something like 3% corrections a year, 5% corrections a year, 10% correction a year, going back like 100 years. I mean, it's something, pretty predictable. So don't be surprised if that happens. However, if you look at kind of broader measures of sentiment, I think there are reasons to be a lot less cautious, if I can put it that way. And one is the cash on the sidelines. There's been a lot of talk about this. According to Bloomberg, the amount of money sitting in money market accounts reached, as of a week ago, $6.1 trillion, which is far and away an all-time record. And a lot of people said that, well, this is kind of misleading because all this is money that's come in from banks. Banks haven't paid as much. It's gone into money market funds. But I read Tom Lee. Tom Lee's one of the market strategists who I've respected the most over the past 10 years. He says that's completely wrong. He said just a couple days ago, I can't remember where I saw it, but it was definitely him. He said since February of 23, that was right about the time Silicon Valley Bank started blowing up, and there was a lot of fear amongst these small to medium-sized banks. Since February of 23, total commercial bank deposits fell or have fallen $234 billion. Also, since February 23, money market fund balances have surged from $1.2 trillion to the previously stated $6.1 trillion. So essentially what he's saying is only $234 billion of that, $5 trillion rise is from bank deposit flight. So this is not just, money coming out of the bank. This is money coming out either that's been earned, excess savings. Maybe it's excess interest, that's come from getting more on your cash. Maybe it's money that's come from stocks and bonds. I don't know. But there is a lot more money on the sidelines, and I would say that a lot of that is firepower. A lot of that is dry powder. And I think what you could also say is it's a referendum on the fact that the average investor, so as opposed to kind of institutional or professional investor, the average investor, for the most part, has not been involved in this rally. Obviously, there are exceptions to that. I know our clients have been involved in this rally, or at least the ones that have some allocation to stocks. But and of course, most of you listening have probably been involved in the rally. But the average retail investor has been building cash and certainly not putting more money into stocks. I mean, if you look at the cash flow data, something like, again, this is also according to Bloomberg, I think only 186 billion have come into stock funds, either mutual funds or ETFs, over the same period of time. So the amount of money going into money markets has dwarfed that. And I think, to me, that means that we're not sort of at the peak of speculative froth like we saw in the spring of 2000, right before the dot-com bubble popped. I think that's a bullish sign. The other thing I think is bullish, and because I'm reading more and more headlines about how this reminds people of the dot-com bubble, and there's certainly some echoes, right, with everyone chasing the artificial intelligence stocks. You mentioned the word artificial intelligence or AI, that tends to lead to a stock pop. So I get it, but if you actually look at the companies leading, I should say, this rally, I think that's where the similarities end, in my opinion. There was something from Piper Sandler about a week ago, or maybe a week and a half ago, that they looked at different, what they call factor performance. In other words, what kind of stocks are leading the charge. And they compared to, and they went back to 2000, like I said, spring of 2000, right at the peak of the dot-com bubble. And what they found is that the companies, kind of the pipe dream growth companies, if you will, those with the lowest return on equities, those with the least earnings power, they were the ones fueling the move. It was a highly speculative move. Okay? Compare that to today, and if you look at what has the most momentum, it's almost identical to the performance of the stocks with the highest profitability, the highest earnings growth. So again, you could argue that there's some speculative froth building, and that's probably accurate. But the speculative froth is building in companies that are highly profitable, in many cases with stellar balance sheets. So it's not the same. Okay, it's not the same. It's a different caliber move than what we saw 24 years ago. There's also this kind of misnomer that the breadth of the market is really narrow. And it's still true to an extent. I've talked a lot about this, right? And in fact, everyone's talked about this, that last year, 2023, the Magnificent Seven, the so-called Magnificent Seven, were responsible for most of the gains in the S&P, and that is a true statement. However, if you look at things recently, it's hard to argue that the breadth of the market has not improved, okay? So, for example, if you look at it from sectors, I pulled some data from FactSet the other day. This is as of a week ago, but I think it's still pretty accurate. If you look at the sectors that are trading above their 50-day moving average, which is a measure of short-term momentum, the only two that aren't above 50% are real estate and communication services. Go to the 100-day moving average, every single sector is at 55% or higher. Above the 200-day moving average, only two are below 50%, staples and utilities. On average, across the S&P, it's almost 75% of the names above the 200-day moving average. So as I mentioned at the top, there's still pockets of weakness, no question about it. We've talked about this on the podcast. But for the most part, we are seeing a broadening in participation, which in my mind and my experience is not a bearish indicator. That is a bullish indicator. The more companies participating, the stronger the market, which of course is also the opposite of what we saw in the spring of 2000. As the dot-com bubble peaked, fewer and fewer companies were participating. And by the end, I think by March of 2000, there were like literally only a handful of blue chip type stocks and uptrends. The rest of the market had been deteriorating for months. That is not the case today. As somebody put it the other day, I can't remember where I saw this quote, I apologize, but the quote was something like, just because the average stock is lagging the return of the market cap weighted index doesn't mean that breadth is bad. It just means that certain types of stocks are doing better than others. And I think that's a good way to put it. Okay. The other thing that, again, I know I'm kind of spinning this in a bullish way, but I don't want to forget the fact that this market could pull back at any time. But I just see more bullish indicators right now than bearish. And a lot of it is because there are real fundamental underpinnings to this. Forward-looking earnings estimates just hit an all-time high, according to FactSet, just as of a week ago. And in fact, and this is pretty amazing, just in the past 6 weeks, earnings estimates for the next 12 months have gone up 2%. 2%. That's a lot in a short period of time, because if you look at the history of it, in most years, and this is going back, as long as I've been in the business, 30-some years, usually analysts start out the year optimistic, and then earnings estimates drop over the course of the year. That's the usual kind of track record. That has not been the case. The last couple months in particular, earnings estimates have rolled up. Can analysts be wrong? Of course. Can we have a significant economic slowdown the second half of the year? Of course. But it's not just about the Fed. It's not just about interest rate expectations coming down. It's earnings estimates rolling up, which, again, there's a fundamental driver of what's going on. And I've said for years that Fed's important, inflation's important, politics matter, all these things matter. But at the end of the day, you superimpose a chart of earnings growth and stock market growth on top of stock market growth, they're almost in lockstep over long periods of time. It doesn't hurt the fact that labor productivity for the S&P is at an all-time high. After 15 years of no gains, I just saw this the other day, again from Bloomberg. That tends to filter down to the bottom line. I think the other thing I'll just mention before I kind of leave this topic is I think what's been understated is that, the Fed can say what they want to say. I know the Fed's been very public about this 2% inflation target, right, that's what they want to get to. But I don't know that Wall Street loves that. I think Wall Street likes a little bit of inflation. Why? Because companies have pricing power. The worst thing for stock prices is deflation. It might be good for you and me as a consumer. We can get some deals at the mall. But companies don't like that. Companies like to be able to, maintain their profits. And that's one of the reasons that consumer staples have struggled, because they were able to hike prices during COVID when we were all staying at home and willing to pay a bunch for Oreos and Pepsi and everything else, consumer goods. Now they're having a much tougher time passing along those commodity price increases than they were. But in general, market likes a little bit of reflation is what they call it. So the fact that the inflation numbers have come in a little hotter than expectations for January and February, not by much, by like 1/10 of a point in both months, I think that's one of the reasons why stocks have been doing well, because they don't see that kind of deflationary influence on bottom line profit margins. So better productivity, a little bit of inflation, a little bit of pricing power, the harnessing of AI, which makes companies more efficient. All those things tend to fuel bottom line profits. So let me be clear, I am not rip-roaring bullish. I do acknowledge that the market is not cheap at these levels. I do acknowledge that we could have a pullback at any time, would not surprise me in the least. But I just think that the bull argument, a little bit stronger than the bear argument right now. Just a couple of, or at least, one other topic I wanted to get to. Of course, one of the kind of the big piece of news over the past couple weeks has been the commentary from the Fed that still suggests they're probably going to cut rates as soon as June. But I wanted to get into that a little bit further. There are a few takeaways I had from kind of Chairman Powell's conference, I guess about a week and a half ago, where they kind of redid what they call their dot plot, which is the Fed's forecast of where they think short-term rates will be. And the way it is today, they still think that they're going to cut rates 3 times this year. They were slightly more hawkish isn't really the right word, but they pulled back some of the expected rate cuts for 25 and 26. But still, I think the main takeaways that I had was, given some of this slightly more hawkish inflation data, the Fed could have referenced that. They could have said we're going to take a slower path. They did not do that. They did not do that. And that was kind of the main takeaway for me. The Fed still believes that they are closer to being able to cut rates than not. And I think that's been very well received. And just that the slower pace of rate cuts is likely. I've said multiple times over the course of the last few weeks that slower is better when it comes to rate cuts. I referenced a piece from Ned Davis Research that showed that if you look at if you go back 100 years and look at slow hiking cycles, and by slow, Ned Davis defined that as less than 4 cuts a year. The year before the first cut, the markets averaged 5 and change percent. Obviously, it's better this time around. A year after the first cut, almost 24% average gain for the S&P, and over the prior easing cycle since 100 years ago. Okay. Meanwhile, fast cycles have tended to produce only a 5% annualized return for the S&P in the first year. And why do you think that is? Well, normally the Fed has to be aggressively cutting rates when we're in a recession, when there's a lot of concern about earnings growth. So the fact that the outlook for earnings has actually improved recently, and that the Fed is likely to take a more deliberate pace, I think bodes well going forward. So, I didn't want to talk too much about the Fed today, but since they've been very much in the news over the course of the last couple of weeks, I thought it was worth mentioning. So let me pivot a bit here. I mentioned it at the top. I wanted to talk a little bit about bonds. I get it with the stock market doing well. Nobody's that excited about a bond market that is still negative year to date. And if you look at the Barclays Aggregate Credit Index, which is sort of probably the most widely followed bond index, it's similar to the S&P for stocks. So the Barclays Aggregate Credit Index is still negative, I think about 1.4% or something like that this year. But remember, that's just the tip of the iceberg. It has been a terrible time for fixed income investors over the past few years. The bond market is still in its longest drawdown ever recorded at about 44 months and counting. 44 months. Okay? As of a week ago, according to my math, we're still down on the Barclays Aggregate Credit about 11.3% from the peak in 2020. And bonds over the last 7 years have returned less than 1% a year. Stocks, according to the S&P 500, have returned almost 10.5% a year. So you can understand why people are frustrated, right? You have the stock market doing well. Bonds have only acted as a drag on your performance, and they certainly have not helped hedge risk in any meaningful way, because like in 2022, when stocks got killed, the S&P was down over 20%, bonds were also down double digits. So not only have they produced no return in the good times, they hurt you in the bad times. Let's put it that way. However, as investors and supposedly wise investors, our job is to look forward, not stew over what has happened in the past. And the reason that most individual investors don't do well in the markets because they talk about last week's story, not the story to come. And the reality is there is a very strong statistical correlation between starting yields and future returns. I read a really good synopsis of this from Charlie Bolello. He said that I'm not sure, he went back to 1976. Okay, I was trying to see how far he went back. He went back to 1976 and looked at the future 7-year forward returns for the Barclays Aggregate Credit Index with given certain starting ranges. When the 10-year Treasury was in this range, but 3.6 to 4.5%, okay, in the 3.6 to 4.5% range. Right now we're in the 4.3 or so range. That has been suggestive of about a 5.1% annualized yield 7 years out since 1976. Well, you might say to me, Simon, 5% doesn't sound that great. But let's put this in some perspective. So I read a couple of really interesting pieces over the past couple of weeks, and I've referenced these before over the years, both Vanguard and Charles Schwab. And I reference them because they're two of the largest brokerage firms in the world. Vanguard's the largest in the world. Okay, so they have a lot of influence over individual investors. Both of them periodically, I think it's every quarter, I believe, they put out what they call their capital markets forecasts. In other words, based on their internal analysis, what they think is a likely 10-year annualized return for various asset classes, and then every quarter they update it. So obviously, we're still here in March, early April. They have not, we don't have the first quarter data yet. But what was very interesting is at the beginning of the year, I'll start with Vanguard. They see U.S. equities over the next 10 years averaging somewhere between a 3.8 and 5.8 return per year, annualized. 3.8 and 5.8. For U.S. growth stocks specifically, which of course have done exceptionally well in the past 18 months, growth stocks, get this, somewhere between 1% and 2.5% annualized. They have value stocks up between 4 and 6. Why do I bring this up? Well, for bonds, in aggregate, U.S. aggregate bonds, they see doing somewhere between roughly 4 and 5%. And remember, U.S. stocks were at 3.8 to 5.8. So they're basically saying that U.S. bonds in aggregate, which I believe includes government bonds and corporates, will probably return about the same, maybe slightly less, but about the same as stocks. That's what Vanguard is saying. What is Charles Schwab saying? Well, they went back to 1970 and found that stocks have averaged about, U.S. large company stocks have averaged 10.5% a year. Over the next 10 years, they think large stocks will average about 6.2% a year. Very close to what Vanguard said, within a half point of where Vanguard was. They also think that U.S. investment-grade bonds will do about 5.7% annualized, which, again, very close to what Vanguard's saying. I have no idea if they'll be right. Very difficult to predict the future, as we all know, but I think the message is pretty clear. Yes, there will be individual stocks that do much better than 5 or 6% over the next year, annualized, next 10 years annualized. I'm sure of that. I think selectivity will help. Discipline will help. Attention to value will help. But on balance, at the macro index level, Vanguard and Schwab are basically saying that stocks and bonds, you should expect about the same. That is incredibly powerful analysis, in my opinion. Incredibly powerful. Because bonds, 2022 it was kind of an aberration. That was the worst one-year drawdown for bonds ever recorded. Generally speaking, bonds, whether you're looking at treasuries, municipals, corporates, have much less volatility, much lower standard deviation than what you can expect from stocks. No guarantee about the future, but I don't think we should look at the past few years as a referendum on what type of volatility you can expect from bonds in the future. So if you could get the same return with potentially, and I stress the word potentially, less risk, or at least less volatility, I think it's a really good time to be thinking about bonds, especially if you believe the Fed. Because what did the Fed say about cash? Remember I mentioned at the top that $6.1 trillion is currently sitting in money markets. That's an all-time high. Most of that money's probably getting around 5%, give or take, right? Somewhere in that range, 4.5 to 5.5, probably. Well, according to the Fed, if you believe the cash futures markets, which can adjust, cash futures markets have cash all the way down to about 3.5% come the end of next year. Money markets will follow that trajectory. Again, we have no way of knowing if the futures markets are right. Anything can happen. This could be completely wrong, but that's what the markets are saying where cash is going to get to. So, add it all up here. If bonds are going to return something similar to stocks and cash yields are going to drop, these are all ifs, but let's say these things happen, maybe you ought to consider going more into bonds, or at the very least, maybe potentially allocating out of some short-term cash investments into some longer-term bonds. Now, again, I'm not giving blanket advice here. There are a lot of reasons that people have cash. Maybe it's because you need to be able to sleep at night. Maybe it's because it's earmarked for a certain expenditure or purpose, or you just like to have a certain safety net. So I'm not giving portfolio advice here. Okay, you have to work on that with your advisor here if you're a client, or if you're not a client, you've got to do your own analysis, your own financial plan, look at your own goals, objectives, and risk tolerance. I'm just saying in a general sense, it may make sense to look at longer-term bonds. Just wanted to do a bit of a 3 or 4 minute primer here, because here at the Wise Investor Group, we do a lot with individual bonds, of course, right? We've always been partial to individual bonds. We might use a fund or an ETF to target a certain asset class, like if we wanted to buy junk bonds or tips or something like that. But for the most part, our core bond portfolios are in individual bonds. But there's a lot of misunderstanding about bonds and how they work. So I just thought this will not be an exhaustive list for sure, but I wanted to highlight a few things that I think you want to pay attention to. One, of course, is the price of the bond, right? Bonds mature at face value, but unless you're buying a new issue, you're probably not paying face value. You're probably paying either a premium, more than 100 cents on the dollar, or you're paying a discount, less than 100 cents on the dollar. Let me be clear. If something's less than $1, it's not cheap. If something's more than $1, it's not expensive. People associate premiums and discounts with overvalued or undervalued, expensive or cheap. Completely different concepts. Get that out of your thinking. That's not how bonds work. The bond's price moves in the opposite direction of the yield. Okay, that's critical to understand. So when prevailing interest rate falls, like maybe they do over the next couple of years, we'll see, older types of bonds become more valuable because they were sold in a higher interest rate environment and therefore have higher coupons. Investors that hold those older bonds, right, they can charge a premium to sell them in the market. On the other hand, if interest rates rise, like they have in the past few years, older bonds become less valuable because their coupons are relatively low. And those older bonds, therefore, trade at a discount. You always say that stocks trade on emotion, bonds trade on math. Okay? There's not a lot of subjectivity that goes into bond pricing. Sometimes there is at, maybe certain municipals, or there's a feeling about a certain corporate bond, but at the sort of the broad index level, bonds trade on math, particularly government bonds. So it's really important to understand that a discount bond is not a cheap bond, a premium bond is not necessarily expensive, because what really counts, and this is the important point, is the net return to you as the investor. And to think about net return, you've got to separate out yield versus coupon. Coupon is just the stated interest rate that the bond pays. So, for example, if you buy a $10,000 bond with a stated coupon of 5%, it doesn't matter if you pay $105 for that bond or $95 for that bond, it's going to pay you $500 a year. Okay? So the coupon is a measure of the cash flow. And of course, we have a lot of retired clients, income investors. They want that cash flow. They want to know what that cash flow is. The coupon tells you that. But from kind of a portfolio return performance standpoint, it's the yield that matters, because the yield takes into account not just the coupon, but the price that you're paying. So, for example, in that $10,000 example, let's say it's a 10-year bond. Let's say it's a 5% coupon. So you're getting that $500 a year, right? But if you pay $105 for that bond, you know that it's going to mature at 100 in 10 years. I don't have a calculator in front of me, but your yield might only be 3% a year, because you're going to lose a few points when it matures. Works the other way. If you pay 95 cents, your yield might be 6 or 7% a year, because not only are you getting the 5% coupon, but you're getting the appreciation to par over time. So it's very important that you do that yield to maturity calculation. And the great thing about individual bonds is you make that calculation when you buy the bond. So as long as it doesn't default, at the end of the maturity period, you have kind of locked in a certain rate of return, regardless of whether interest rates go up, down, or sideways in the interim. So it gives you a lot of visibility into your return. The other thing I would say is you've really got to pay attention to whether the bond has a call feature. This happens all the time where, let's say you pay a premium for a bond and you think you're going to get a certain rate of return for, let's say, 20 years, but you fail to note that the bond could be called at par in 3 years. If it gets called, your ultimate return may be a lot lower than if it makes it all the way to maturity. We call that in the business a yield to worst. So we want to know what the yield to maturity is, but we also want to know what the yield to worst is if it were to get called prior to maturity. I know I'm probably confusing you, but if you're buying individual bonds, you've got to understand these things, or you're going to end up maybe locking in a return that's maybe not as favorable as what you think it could be. Okay. The last thing I'll say, and again, this is not meant to be an exhaustive discussion because there are a million things I could talk about with respect to bonds, but you've also got to know the tax treatment of a bond. And there's all types of different bonds that have different tax treatments, but the confusion I see the most is between corporate bonds and municipal bonds. For the most part, there are exceptions, which I'm not going to get into, but for the most part, corporate bonds are taxed at ordinary income rates. At least the interest is taxed at ordinary income rates, whereas municipal bonds can be tax-free, at least federally tax-free. And if you live in the state where the bond is issued, it could be state tax-free as well. And again, there are exceptions to this, but just stick with me. I'm being general here. But you've got to know what your tax bracket is, because municipal bonds are going to yield, for the most part, less than corporate bonds, given the same maturity length, given the same credit quality. So the higher the tax bracket you're in, the more valuable your municipal bond will be relative to the corporate bond, if that makes sense. In other words, we talk about it figuring out the taxable equivalent. So if I know what my yield is on a municipal bond and I know what my tax bracket is, I can do a quick calculation to see what I would have to get on a taxable bond to do better, if that makes sense. So right now, for example, municipal bonds, tax-free bonds, have, for the most part, the steepest yield curve, meaning that the longer you go out with municipal bonds, the higher the yields are. Corporate bonds are less steep, and treasury bonds, of course, are inverted. Longer termers playing less than shorter. So let's say you went out 25 years and got 4% tax-free on a municipal. If you're in the max bracket, that might be equivalent to over 7% these days. Okay? So you've got to understand the tax treatment of the bond, the bracket that you're in, and the curve. You know, does it make sense to go out further in certain types of things than others? I'm not going to get too much into strategies at this point, but I did think it was helpful to maybe just to review a few basics of individual bonds. Just to reiterate what I said, I am not suggesting that you go out and buy bonds and get out of your money market, get out of your cash. That is a nuanced decision that is very specific to each individual investor. So you've got to do your own homework, and if you're a client here, feel free to consult with me, the other portfolio managers here, and the financial planners here to see if that's the right decision based on your set of circumstances. Up next, I just have a few more minutes. I'll offer a few thoughts on a few individual names that we own. Back in a minute.
The political temperature is only going to get hotter. It doesn't mean you need to lose your cool and make emotional decisions. Tune in every week to hear Simon Hamilton and Chase Henderstein discuss the latest financial trends and what investors need to know. To help filter out the noise distracting you from your sound portfolio management and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Just wanted to briefly hit on a few individual names that have caught my eye recently. As I always say, if you are a client of the Wise Investor Group, I think you can feel confident that we've done our due diligence, we've done our homework, and we've determined that these positions are suitable for you. If you're not a client, it's hard for me to manage your portfolio through the podcast. You really have to do your own analysis, your own homework. The three that I'm going to mention briefly, I also own in my own portfolio, and we own for many of our clients. That represents a conflict of interest, so you can weigh that how you would like to weigh that. But I just wanted to mention a few names. One is MRK, symbol MRK. I think you all know MRK. I mention MRK because healthcare stocks had a lousy 2023. They had a very good start to the year. They have kind of pulled back a little bit for the most part over the course of the last couple of weeks. I think there's been a lot more confidence in growth stocks, particularly AI-related stocks, chip stocks, some of the more defensive sectors. They're still in a decent uptrend, as I referenced at the top of the podcast, but things like staples, healthcare, they pulled back a little bit. So I think MRK is worth looking at. I was reading a piece from JP Morgan. They were talking about their latest drug launch, sotatercept, which is a drug to help primarily breast cancer patients on chemo handle anemia. But they see a really good market for it. And they were just making the point that it's in their work going to go from a $400 million drug in 24 to as much as a $5 billion drug in 2030. But that was just the point of their piece was not just to highlight that, but to highlight the fact that Merck, amongst the sort of the large cap pharmaceutical space, has some of the clearest visibility into bottom line and top line growth. JP Morgan's estimates are calling for high double-digit revenue growth and low to mid double-digit earnings growth over the next 5 years, compounded. And they think there's a lot of visibility into that, given their patent expiration profile, given some of these new drugs coming online like sotatercept, given the continued viability and sustainability of their key franchise, their oncology franchise, Keytruda, and also an understated animal health business, which generates a ton of free cash flow. So those are pretty impressive forecasts. High single-digit top line, low to mid double-digit bottom line. And for that, you're only paying about 14 times earnings at this point. 14 times. So I think Merck's risk-reward profile, if you will, trade-off, is very interesting at this point. Obviously, there are risks to the story. It's an election year. We all know that healthcare and drug prices are politically charged. Any increased rhetoric about drug price caps could make this sector volatile, and Merck specifically volatile. Also been a lot of interest, of course, in weight loss drugs. Merck does not have a good franchise there, so maybe Merck is not getting as much attention for that reason. But I think JP Morgan highlights those potential risks and rewards pretty well, and at 14 times earnings, that is not a demanding valuation. Speaking of not a demanding valuation, Alphabet, the former Google, has been kind of a little lost in the shuffle recently, I think, in the sense that obviously there's a lot of attention's been paid to the pure play chip stocks like NVIDIA being the poster child. Microsoft, of course, has a lot of AI exposure. Well, Alphabet does too, but I think there's a little bit of a perception that they have the second or third class product there. But there was some interesting news just in the last couple of weeks that Google could potentially partner in a more sustainable or a more significant way with Apple in terms of getting the Gemini, their flagship AI product, installed on Apple devices as not just something that users can access, but actually part of the hardware. That is a really interesting potential, I say potential development there. I think Alphabet has been given kind of second-class status, and that may belie the fact that they have some real opportunity over the next 5 years in AI. The key point I'm making this morning is not really a forecast of their AI potential, but the fact that you don't have to pay a lot for Google. So if you look at Google today, trading about 20 times earnings, which is essentially a market multiple. That's basically where the S&P is. But get this is a significant discount to where they've been over the course of the last few years. They're trading about an 84% of their 5-year. So it's a 16% discount. That's according to FactSet numbers. But this is what's more interesting. Consensus estimates are calling for about 11% compounded annual revenue growth over the next 2 years, about 11%. Get this, 16% 2-year estimated compounded earnings growth. So if that's right, and these are consensus FactSet estimates, if that's right, you're paying only 20 times earnings for a company that could produce mid-double-digit, mid-teens, I should say, bottom-line earnings growth. That's not a lot. That's not a high valuation for this. And the stock is still down. I think it's basically down 1% from where it was at the end of 2021. So the stock really hasn't done anything for an extended period of time. So what's the risk? I mean, the risk is kind of what I said, I guess it's possible that they do have a second-class product. Maybe their product is not as good as Microsoft. But A, I wouldn't bet on that. B, I wouldn't underestimate a potential deal with Apple. C, I think the shares are priced for less explosive uptake than what you've seen with some of the other companies. So, if you're looking at that Mag 7 and saying, gee, I'd like to own something there, but I don't want to pay the valuations that you have to pay for, some of the others, maybe Alphabet's worth a look. See if it makes sense for your portfolio. As I mentioned, it is not without risk. Okay? Just wanted to mention one more, and then we'll call it a day. A completely different type of name that, quite frankly, it's probably a boring name for most. Good old AT&T. I think you all know AT&T, symbol T. Their missteps have been very public over the last few years. You remember back in 2015, they decided in all their genius to own DirecTV, which had a business model of putting dishes on roofs. I had one myself, which I still can't get off the roof. They paid $67 billion for that and then sold it for, a bucket of bolts, 6 years later. Then, of course, they made another huge deal for Time Warner, only to see it spun off 4 years later in 2022 for a lot less than they paid. So those are the big sort of public missteps that AT&T has made. But they have a new management team, and they're kind of sticking to their core business: wireless, wireline business, fiber broadband. They're not making those multimedia deals that they made a few years ago. It's a much easier business to understand. And they're trading at a valuation. Talk about undemanding. They're down to 7 times this year's free cash flow consensus. That's the cheapest they have ever been. Ever been. And they're paying about a 6.5% dividend yield to boot. What's going on? Well, I think the overall industry obviously has struggled, but it seems more rational to me than it has in a long time. There was a really good article in Barron's, I guess it was a couple weeks ago, from Jack Howell. I thought he did a good job talking about the fact that wireless operators see pretty good demand, but with competition remaining rational. We're not seeing those price wars that we used to see. He was making the point that a couple years ago, if you switched service providers, there was this incentive deal where you got all kinds of bennies and free phones and all these things. The companies have really stepped away from that, really focused on keeping their prices up. They're not, giving away the business to bring in customers. So the margin profiles are much better across the board in the industry. They also are largely through their most capital-intensive build-outs. They had to spend, I think AT&T had to spend, I don't know the exact number, but I think it was over 140 billion on upgrading their 5G network. But in more recent times, AT&T just announced, I guess it was their last quarter, that they're trimming about $6 billion off of their expenses and looking to trim another $2 billion. Much more rational capital expenditure budgets than what we saw a few years ago. So they're on the other side of these huge acquisitions. They're on the other side a lot of their build-out, more rational pricing. They're trading at about a 20% discount to Verizon. And I'm not knocking Verizon on the show today. I'm just saying they're trading about 20% discount to Verizon on a price-to-free cash flow basis. They expect to pay down, according to this article, Jack Howe, they pay down almost $7 billion in debt they expect to pay down this year. So the author thinks that their dividend is well supported. And they have a lot of potential in fiber broadband. Fiber broadband has been kind of the thing that they've spent the most on in the last few years. It has low customer turnover. It costs less to run than traditional copper wires, and much less maintenance costs. So for all these reasons, I think the profit margin outlook for AT&T is improving regardless of what happens on the customer demand side. And I think that supports ultimately the potential for the stock to break out of a multi-year doldrum. As I mentioned, if they can keep that dividend going, you're going to collect that 6.5% while you're waiting for better execution. Of course, there are risks to the story. There's always economic risks with telecom companies. They do not respond well in a potential economic slowdown if customers are cutting service or looking for the cheapest alternative. They do have some litigation overhang. There is talk that some of their copper wire infrastructure had pollutants in it. So there are definitely risks to the AT&T story, but at their lowest valuation ever, like I said with Merck, like I said with Alphabet, maybe some of that risk is already baked into the valuation. See if they're right for you. Do your own homework. And remember, I own these three personally, and we own these for our clients. So that represents a conflict of interest there. As always, folks, I hope that was helpful. We're just coming, of course, to the end of the first quarter. Start to have earnings reports come our way starting early to mid-April. So we'll certainly bring you more information on what we're hearing from some of our top holdings. Hope it was helpful. Until next time, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.